Alright, so this is continuing our Financial Markets Institutions lecture. We were just talking about investment banks and the IPO process. Got cut off by the software. Let's look at some IPOs that have recently happened. IPOs are interesting because they're sort of show you the new ideas, the new businesses that want to expand and want to raise a whole lot of money, which helps you keep a finger on the pulse of the business world. Is who's going public, who's issuing lots of stock will tell you what kind of businesses are flourishing at the moment. One place I like to look is Hoover's. It's a website. They have lots of different things, but they have a thing called IPO Central. They just list a whole lot of recent IPOs. But you can go through and look at all the recent IPOs that have filed. That means they've filed what's called Form S1, which is called a prospectus. It's just a lot of paperwork they have to file that says what they're going to use the money for, what type of business they have, all their different risks, things like that. I actually have a copy of one I can show you. But the most recent company to file that wants an IPO is actually SeaWorld Entertainment. I don't know if you know what SeaWorld is or not. SeaWorld's an amusement park company. So they actually own lots of different amusement parks, but their big ones are where they have Shamu the whale and things in Florida is a famous one, in Orlando, where people go and watch aquatic shows and things like that. But it's just an entertainment company. It's kind of one of those silly things but they make a lot of money on those, obviously. And I actually read through their filing. They're raising $100 million, and they're not actually expanding. Here's their filing if you're interested in what one of these looks like. This is their prospectus, and this is a very long document, so we won't go through it all. But one of the things they have is use of proceeds in here, and you can read through it. And they're just having a capital restructuring. They're using the equity to pay off a whole lot of debt they issued in the past. So they're not expanding or anything. But that's one of the reasons people go public. They issue a whole lot of stock in order to restructure the liability side of their balance sheet. But their ticker symbol is going to be SEAS. If you know what a ticker symbol is, that's how, if you want to trade a stock or something, you put their ticker symbol in, or give it to your broker, or if you have an online broker, you go on or you can go, for example, to Yahoo Finance. Let's do that real quick. Here's Yahoo Finance. You can put a ticker symbol in up here, and it'll show you the stock chart for the company. Well, if you put in SEAS, C's, which is the ticker symbol that's going to be for SeaWorld, and hit enter, it can't find the company because it doesn't exist yet. If you put in something like KO, which happens to be for Coca-Cola, that's going to be in there because Coca-Cola has already been public. They've been public for a long time. And so it'll bring up Coca-Cola, and then you can look at their stock chart going back, I don't know how far, they go back to 1962 here, but they've actually been public longer than that. That's just all the data they have on here. But you can't get anything for SeaWorld because they haven't started trading yet. And until you have an IPO, your stock doesn't really exist in the trading world. So that's what an IPO is. It's the bringing out of a new company, and then from then on they have a stock that trades, and you can go on to Yahoo Finance or CNBC.com or whatever finance media outlet you like, and you can see that company. Alright, let's move on and let's talk about markets. We've kind of transitioned from the intermediaries, which were the commercial banks and things like that were poolers of funds, and we got to investment banks, which we also call an intermediary, but they're kind of a middle ground because they're not really a pooler of people's money. They're a service provider. They create new markets, which they create these securities that trade in a marketplace, whereas there's not a middleman anymore. If you own a share of stock, you own the company. You didn't deposit money and then the bank gave the money to someone else. You actually bought the stock. So let's talk about marketplaces now. Markets, a lot of this stuff is just definitions. So like I've written in here on this outline, debt versus equity markets. That's just definition you need to learn. Debt is borrowed money. Equity is not borrowed, it's ownership. So if you own, for example, a bond's a long-term debt instrument. We're going to have a whole chapter on bonds later in the semester, but just real quick, bonds a tradable security that's a debt contract. So you lent money to someone and they are contractually obligated by law to pay you back plus interest. Whereas stock is an equity ownership, in that you didn't loan the company money when you buy their stock. You actually bought a stake in the company. You own part of the company. You might get paid back, you might not. You don't know. It depends on if the firm makes money or not. If they don't make any money, you never get paid anything back, and your stock price goes down, and eventually it goes to zero if they lose enough money. Money markets versus capital markets. Money markets are securities that mature in less than a year. That's the definition. Capital markets are securities that don't mature in less than a year, which includes equity. It never matures. If you buy an equity stake, you own the company forever, essentially, until they get bought out by somebody else or go bankrupt, or they may never end business, which means you own them forever. Anything matures in less than a year we call a money market. There's a very robust market for money market securities. It's the largest marketplace out there. There's lots of different money market securities. We're not going to go into all the different types, but for example, the government issues what's called treasury bills. Treasury bills are short-term government obligations they have to pay back. So they might issue a 1-month treasury bill where they borrow money and then they pay it back a month later. Because they're so short-term, they're considered almost as good as money because they have very little risk. Even if you buy what's called corporate paper, which is issued by a corporation, not by the government, they're probably not going to go bankrupt in the next month. So you're probably going to get paid back. So it's kind of considered as good as money, and that's, I think, why they call them the money markets. But let's skip exchanges, OTC real quick. Primary versus secondary markets. More definitions. Primary markets where new securities are issued. So for example, an IPO. An IPO, initial public offering, they go out and create a new stock, and I talked about they go through their brokerage arms, the end investors. The investors buy the securities. Money flows in, goes to the company. So there was actually money exchanged from lenders to borrowers. That's the primary markets. The secondary market is where existing securities trade. So most market activity is secondary market activity. Meaning if you go on that Yahoo Finance site and look at this Coca-Cola chart of their stock price over the years, each one of these little dots on this line was the price of their stock, where their stock traded between two investors. But Coca-Cola, the company itself, had nothing to do with that. It was just two investors trading Coca-Cola's shares with each other, and this is the price that they traded it at. So that's called the secondary market. There's actually no money going from lenders to borrowers. There's just two investors trading a security with each other. The common question asked is, are secondary markets that important? Meaning, obviously primary markets are important because that's when finance happens. That's when money is traded between lenders and borrowers. Secondary market, there's really no indirect or direct finance happening. It's just people trading. And trading gets a lot of bad press in that it can cause negative things to happen to companies. If a company's stock price goes way down, they can't raise money in the future and they can go bankrupt really fast. So is trading bad necessarily? Well, there are a couple good things about the secondary market. One is they provide what we call liquidity. Liquidity is how easy it is to buy and sell a security. Markets that have very liquid secondary markets means you could buy, for example, you could buy Coca-Cola's or Microsoft, whatever. You could buy their stock today. Here, let's look at just a one-day chart if we can. I'm not sure I can here. I can't, unfortunately, right now. But take my word for it, their stock trades constantly. So when the markets are open, they trade every second. Meaning I could actually buy Coca-Cola shares right now and sell them a minute later. I could sell them 3 seconds later if I wanted. If that's the case, the security is going to be a lot more valuable than if it's not liquid. Take like real estate, for example. That's classic non-liquid asset. If you buy real estate, it might take you 9 months to actually turn around and sell it. You got to go out and hire a real estate broker. They got to go out and try to find someone to buy it. It could take a while. Non-liquid securities trade, and assets in general, trade for a lot less value because they're more risky. more risky assets are not as valuable as less risky. And liquidity risk is one type of risk. We'll leave it at that. The other thing that's important is they provide information. When we have liquid markets, we always know what the price of things are. So we can, in any given day, know how valuable Coca-Cola's company is. We know how valuable wheat is. We know how valuable oil is, how valuable gold is, how valuable bonds are, what interest rates are. All that's information that business owners can use to forecast for the future and make good business decisions. When you have what we call a command and control economy, something like Russia used to be, there's still some countries like Cuba and North Korea, countries like that, they don't have marketplaces. They have one person in charge who sets prices. Well, we don't know if they're setting the price right. When you have a marketplace, you have competition, you have a lot of different traders who are bidding prices up, pushing prices down, and then the collective intelligence of the whole trading community sets the price based on supply and demand. So we think that price is probably closer to the correct price than if you had, say, one guy in the government who was picking what the price of bread should be and picking what the price of gasoline should be. Then you can take that information and make good business decisions on it. You know what's valuable, what's not valuable. It gives you supply and demand. And so that information is very valuable. And so if we didn't have secondary markets, we wouldn't have that. All right. Real quick, because we're running up on our 15-minute, I don't want to get into a third video here. Let's talk about exchanges versus OTC. That has to do with a physical exchange where traders meet this is more definitions. A physical exchange, traders meet face to face and they actually trade with each other. Those hardly exist anymore at all. Most physical exchange have gone to networks where you have computers and phones and stuff, and that's called OTC, which is over the counter. Original OTCs were all phone networks, so there's no actual physical place where everybody's trading with each other. They just call each other up on the phone. Now we have very complex computer networks, things like the NASDAQ exchange, for example. There is no technical physical location of the NASDAQ exchange. It's all done on computers. They have a location, but there's no trading that actually happens there. It's just their headquarters in Times Square in New York, but they don't actually trade anything there. And so that's the way kind of all markets are pushing. They're pushing towards this OTC, which is based on a computer network. Other markets, other than stocks and bonds, there's things, for example, derivative markets. There's currency markets where currencies are traded. We'll talk about derivatives later in the semester. Let's not get into them now because we're running out of time here. Real quick on this markets versus intermediaries. All I really want to touch on there is if you look at where most of the financial activity happens, it happens in intermediaries. So there's lots of stats put up about how much money is raised through, say, commercial banks through intermediaries and how much money is raised through investment banks. It's vastly higher on the intermediary side for almost all countries, meaning that the bulk of finance happens through intermediaries, middlemen, not through direct finance. Why is that? That's the kind of the question. Why is so much more money raised through intermediaries than through stock markets or bond markets? Stock markets get a lot of press in the Wall Street Journal and media outlets, but it's actually intermediaries that do most of the finance. The reason one is transaction costs. It's a lot cheaper to have one middleman who pools everybody's money together and makes investment decisions than having every investor deciding where they want to put all their money. So just take a mutual fund, for example. Mutual fund, you put your money in and they invest in a bunch of stocks for you. So you only have to make one choice. What mutual fund do you pick? You don't have to pick all the different companies you're going to invest in. The other is asymmetric information. If you're a small business and you want to get a loan, you can't go to the stock market because the stock market doesn't know anything about you. They don't know every restaurant on every street. All they know is the very large corporations they know enough about that they can go to the stock market. Okay. We're going to end it there just for time reasons because I'm running up on my 15-minute limit again. We'll go ahead and just skip the rest of the stuff. It won't be on any quizzes or tests. We might touch on it later in the semester, but thank you.